Good afternoon and welcome to FXTM's Japanese Candlestick Strategies webinar. Today you'll learn how to understand major candlestick patterns, apply candlesticks to identify trend reversals, master your strategy, and so much more. Remember to send us your question at any point during the webinar. Now, without further ado, please welcome your instructor, Mr. Andreas Salasinos.
Hello everyone, my name is Andreas Salasinos and I would like to welcome you all to today's webinar, Japanese Candlestick Trading Strategies. I promise it will be a very interesting webinar today, and I will show you how to use candlestick patterns to trade the financial markets. But before we do that, let's go through the agenda for today. And of course, we will visit some bullish and bearish patterns. We'll do a small revision, and then I will walk you through some trading strategies. And of course, I will introduce filtering, which is very important to increase the probability of our trading. And we're going to do that through oscillators, trend lines, moving average, Bollinger Bands, support and resistance, and combination of the above methods. Of course, I'm sure you remember that you can post your questions anytime throughout the webinar, and I will try to answer them as fast as possible. So let's get started. The first candlestick that we're going to discuss is, of course, the long wide body. The long wide body implies a bullish reversal, especially if found after a downtrend, right? So it's just a long wide candlestick. It's called marubozu in Japanese terminology, but we don't really need to know the Japanese name. The important thing to remember here is that it's a long wide body or real body. This is how we call this rectangle between the open and the closed, body or real body. We use both terms interchangeably, and there is a small or a tiny shadow or no shadow at all. It's a bullish pattern, especially when found at the bottom of a decline, of a downtrend. Long wide body, then the very famous hammer. Again, hammer is a bullish pattern found at the end of a decline. And the specifications, if you like, of a hammer, it's a short body. The color is not really important. It might be either white or black. The important thing to remember, though, is that there is a long lower shadow. As you see here, there is a long lower shadow, which is 2 to 3 times the length of the body. Okay, this is the specifications of the hammer. And again, the upper shadow is very tiny or does not exist at all. Okay, then inverted hammer, it's another pattern. The specs are very similar if found at the end of a decline, at the bottom of a downtrend, and there is a long upper shadow, a small real body. The long upper shadow is 2 to 3 times the size of the body, and there is a tiny or no lower shadow at all. To be honest, I don't like this pattern, guys. All right. It doesn't. I don't feel very comfortable to take a long position after this pattern at the decline. I prefer the hammer. Okay. I can go back and show you one more time the hammer. I prefer this formation compared to this one, but nevertheless, this pattern, the inverted hammer, is considered a bullish hammer. That's why we need to combine these patterns with other methods, if you like, with oscillators, with indicators, so we can feel more confident to take the trade. All right? It's very important to have confidence when you take the trade. So that is that about the inverted hammer. And then we move on to the long black body. Now we're discussing, of course, bearish reversal patterns. And this is found at the top of the uptrend. And it's a long white body with tiny or no shadows at all. Okay? And the shooting star, or inverted hammer if you like, but if an inverted hammer is found at the top, it's called shooting star in Japanese terminology. Okay? So that's why we call it shooting star. And that, yes, I feel very comfortable with to take the trade after this formation. Again, the specs are very familiar. Short black or white body, an upper long shadow, 2 to 3 times the size of the body. Okay? The lower shadow, very tiny or does not exist at all. All right, very good. And then, of course, the hanging man, which is a hammer at the top. This is what it is, but they call it hanging man. And again, I don't really feel very comfortable with this formation at the top to take a short position. But if I combine it with some other methods, then I will feel more confident to take a short trade. So again, confidence is very important in this business. Psychology that implies discipline, right? So another bearish formation, one line formation, which is called hanging man, and 2 line patterns, bullish reversals, harami, very popular pattern, guys. Harami, do you know what it means in Japanese? Harami? Yes, if you like, you can post your answer here. Let's see how many people know the meaning of harami. And as you see here, let's go through the specs for this bullish pattern. It's a short candle of any color. That's why we painted it green, so we can imply that can be any color, right? It might be bullish or bearish color. This is what I mean, actually. And that short candle, which is of any color, it's enclosed within the body of the longer candle. Actually, the body of the shorter is enclosed within the body of the longer candle. All right? So this is the harami formation. And here, in the case where you have a doji instead of a small body, then it's called harami cross. Nothing changes. The meaning is exactly the same. Okay? We have a question here. Let me see. Let me find my arrow. All right. I have to click here, I guess. What is that? Question. So the answer is baby, Mr. Ademir, and pregnant, Mr. Michael, and harami is equal to pregnant, Mr. Nasser. Very good. Okay, yes, it's a pregnant lady, yes, and what you see there, the shorter candle is the baby. So congratulations, guys. All three are correct. It means pregnant. This is what it means, right? Excellent. So let's go on. And piercing pattern. This is another two-line bullish reversal pattern. Now, the specs for this one, it's a long white candle, like you see here, that follows a long black candle. So the color matters in this case. Now, let's go a little bit further, and the white candles open, so this guy here, is below the black candles close here. So the open of the white one is below, is lower than the closing price of the previous black candles. Now, in foreign exchange, they are equal, right? Because about more or less in foreign exchange, the price is continuous, where one candle closes, then the other one starts, right? Begins. So that's why I specify there that in foreign exchange, it's a little bit different. They are equal. Okay, guys, but don't forget that these technical analysis methods and techniques that, and theories and concepts that I show you here apply to every financial instrument, either that is foreign exchange, or it might be CFDs, or it might be stocks, yes? So that's why we have to give the whole picture, and then we can make the adjustments to the specific market. Very good. So this is the piercing pattern, but we have more. The white candles close now, so this is the closing price in this case, is above the midpoint. That's why I included here this green dotted line to show the midpoint of the black candlestick. So the closing price of the white should be above the midpoint of the previous black candlestick. All right, so that is the definition of piercing line. And we're moving on to the engulfing pattern. Can you hear me well, guys? Please type yes if you can hear me well, or type not very well or no, so I get some feedback, please. And engulfing pattern, it's another two-line bullish reversal, and it's a long white candle that follows a black candlestick. In this case, of course, is green, but you understand what I mean. It's a bullish candlestick, right? White implies bullish, or any other color that you prefer, as long as you understand that the closing price is above the opening price. All right, very good. So there is a bullish candlestick that follows a bearish candlestick, and the white candles open is below the black candles close. So this is the case here. This opening is below this closing price. All right, thank you, Mr. Elton. Very good. And the white candles close is above the black candle open. So in this case, this closing price is not just above the midpoint, but it's above the open price of the previous black candlestick. All right, this is the difference between the piercing line and the engulfing pattern. And let's move on to bearish formations. And here we have the harami at the top. So now we know about this pregnant lady with the baby, right? When found at the top, it's a bearish pattern. And if the baby, if you like, is a cross, then we call it harami cross. But the signals are the same, and the meaning is exactly the same. Very good. And the specs, a short candle follows a long white candle, not white, any color actually. Candles may be black or white, and the short candle's body is engulfed within the long candle's body. So this body here is engulfed within the previous longer body. This is what it means. And then, of course, is the Harami cross. Dark cloud at the top is what we call piercing line at the bottom. So at the top, we have a long black candle that follows a long white candle. So you have this formation here, and then the black candles open, is above the white candles close. So this one is above this closing price. Once more, in foreign exchange, they are about more or less the same price, okay? And the black candles close, this is the closing price, is below the midpoint of the previous white body midpoint line. So the closing price of this guy here is below the midpoint line. All right? All right. So it's like my voice breaks up. All right. I don't know why, guys. So please let me know if we have a technical problem here or it's on somebody else's side. Okay. All right. Sorry about that. So this is the bearish reversal pattern called dark cloud. Engulfing pattern at the top, again, it's a long black candle that follows a white candle. Now, more specs. The black candles open, this is the open price of the black candle, it's above the white candles close. So it's above this price here. Thank you, Mr. Charles. And the black candles close is below the white candles open. Very good. Dark cloud then buy. Where's the dark cloud, guys? Mr. Pang Yong Teng, where is dark cloud? Here? No, we don't buy. I will show you how we will sell there, right? It's a bearish formation. Mr. Pang, it's a sell, right? I will show you how we do that. Just hold on a few more minutes, all right? And then we move on to the strategies. I just want all of you to be on the same level. That's why I'm going through these basic patterns, all right? And then I will show you the filtering and the confirmation. All right. Excellent. Then we have more than two lines formations. And of course, it's the tower bottom. And it's very easy to remember, actually. But let me show you the formal specs for that. So you have a prior trend. Here is your prior downtrend in this case. Then you have a long black candle. This is your long black candle, and this is your tower, if you like, right? And then you have what? What do you have in between here? You have congestion, sideways movement, small candlestick signaling indecision, right? And then what? A long white candle, which is what? Your second tower, right? Very good. So that's why we call it tower bottom. Here we are. Very good. All right, let's move on. We have a question. Can we check any live candles? Of course, Mr. Deepak Kumar Tiwari. Of course, we'll do that in a few seconds. And bearish reversal patterns, tower top. So without looking at the specs, there is a prior trend, uptrend in this case, a long white candle in the direction of the uptrend, small candlesticks going sideways, right? And then a long black candlestick that implies a reversal. Okay, that's why we call it bearish reversal, and we call it tower top. So once more, you have a prior uptrend, long white candle in the direction of the trend, congestion area, sideways, usually small candlesticks, and then a long black candle signaling the end of the uptrend, the end of the congestion, and the beginning of a downtrend. Okay, guys, so we are ready to move on, and let me see if we have any questions here. Do I have any questions? Yes. Why don't I see them? Could you please explain tower bottom again, Mr. Abbas Yusuf Ali? I will do that right away. Let me find my arrow. I lost my arrow. Okay. Tower bottom. We go back. Here we are. So what do you have? You have a downtrend, right? And then what do you have? You see a long black candle in the direction of the trend, of the downtrend. Very good. Then small candlesticks going nowhere, going sideways. Congestion, that's why we call it congestion. And then there is a long white candle signaling the end of the congestion, the end of the downtrend, and there is a lot of momentum, a lot of buying power, a lot of demand to push prices higher. That's why there is that. It's a long white candle, and this is a bullish reversal pattern called tower bottom. All right? Is that good? Is that clear, Mr. Abbas? Please type yes or no or not sure so I get some feedback, please. Very good. Yes? All right. Thank you. Excellent. Another question. What time frame do you use for candle recognition? Any time frame. I have been having challenge using the candle to predict price movement. Which time frame is the best to use on Japanese candlesticks? Any time frame. Can we go back to the tower top? Okay, guys, for you who are asking about the best candles, about the best time frame, I'm sure that you all know my view regarding that. It's the best time frame for you based on your trading profile, your character, your aggressiveness, how much conservative you are. But nevertheless, I know that you want me to say 30 minutes or 4 hours. So here is your answer. 30 minutes or 4 hours. These are good time frames for me. All right? But you can go as low as to 5 minutes and high as to 1 month. We will go live now and take a look at different time frames. You will call the time frame and we'll try to find some candlestick patterns. All right, guys? Very good. So we have more questions. Can we go back to tower top? This is the last one. Tower top, we'll do that, of course. Tower top, here we are. Mr. Gilbert, here we are. You have an uptrend, a white long candlestick in the direction of the trend, then small candlesticks going nowhere, and then a long black candle in the opposite direction, of course, since it's black, signaling the end of the congestion and the beginning of a downtrend. All right? Is it good? You have any questions, or shall I move on to strategies? All right. So here we are. That's why we are here for this first strategy, bearish reversal using Harami pattern, which Harami, it might be either bullish or bearish. In this case, it will be bearish, and using an oscillator to filter the bad trades. All right? So we are looking for high probability setups. Never forget that. We don't want to take any setup, we want to increase the chances so we have higher probability to trade, and we do that by filtering and confirmation. So what do you have here? You have this Harami here. Yes, in this case, this opening price is at the same level as the closing price of this candlestick here, because we're talking about foreign exchange. Other than that, you could have this body even a little bit higher, as long as it's between the open and closing price of this candlestick here. So this is the definition of a Harami. Now, how do you filter that? You filter that with an oscillator. In this case, we are using, do you know which oscillator I'm using, guys? Does it ring a bell? You can use any oscillator, of course. And in this case, I'm using, all right, I will let you guess, Morningstar, RSI, Mr. Elton, congratulations, you're absolutely right. We are using the RSI. How do we know? Because we use the 30 oversold, the 70 overbought, and the 50 midpoint. Yes, Mr. is very correct. So that's why we are saying that most probably the RSI. So when the RSI oscillator is at extreme levels, at overbought area above 70, right, it means that prices most probably have reached a very high level and a correction is about to happen, most probably. Nothing is 100%. So we do the filtering to increase our chances. So if the market is overbought and we see a reversal pattern, then we feel more confident to sell. Okay, is that clear, guys? Please type yes, no, so I get some feedback. So here is your Harami. This is the Harami, the last two candlesticks. And we sell there when the next candlestick breaks below the low of the longer candlestick right here. All right? And since the oscillator is overbought, then we feel more confident to go short. Very good. Stop loss. Never forget your protective stop loss to protect your capital. And in this case, we place our protective stop loss at the high price, at the high level of the long candlestick. So one more time to explain the RSI. Yes, the RSI is this guy here, is this oscillator. I will switch now to the MT4 platform and I will attach it, of course. And it looks like that. It's the lower band of 30, the upper band of 70, and the middle midpoint, which we call 50. So when the oscillator is above 70, then we say that prices are at extreme area, are overbought. So when prices are overbought, it's not the best thing to go long. It's not the best thing to buy more. All right? So it's better to wait. And when prices are below 30, it's oversold, and you expect prices to reverse. But just because the oscillator is overbought or oversold, it doesn't mean that you have a signal to buy or sell. You need first to identify a reversal pattern, filter then with your oscillator, and then wait for price confirmation. What is the price confirmation? The price confirmation is when prices go below this low price here, guys. Okay? Is that clear? All right. Mr. Oluwaswen, is that clear? All right. Very good. More questions? RSI depends strongly to its duration. Why we must select 14 as a default? Mr. Said, what does it mean? RSI depends strongly to its duration? Do you mean it depends on the time frame? Do you mean that there is an analogy between the RSI periodicity and the time frame of your price chart? This is what you are implying, Mr. Said? All right, please type yes or no. Give me some more explanations, Mr. Said. It's period. Okay. So allow me to disagree. The developer of the RSI, Relative Strength Index indicator, suggested to use 14 periods as default. Okay? Now, if you like to use different periods, it's not a problem. All right? But I don't know how we can relate the periodicity of RSI to the time frame of the price chart. Okay, so I would like to say that 14 is a good period for RSI. If you want to change it to 10 or 9, something like that, let's go ahead and do it, but please do your testing first, right? All right, then we have another Mr. Conrad of Congo. Hello, Mr. Conrad, how are you? And using RSI when it is overbought and oversold, yes, exactly. When it's overbought, it's above 70, and when it's below 30, it's oversold. Perhaps Conrad was trying to explain to me further what the previous friend asked there. Mr. Conrad, please clarify if it's a statement or a question, and an explanation why we should place our stop loss at that point. All right, very good. Another question from Nigeria here. So why we should place this stop loss here? Because if prices go above this high, then the Arami formation is not valid anymore, right? We want to have a protection. That's why we use a protective stop loss. We don't like to use this concept of 50 pips higher or X pips higher. We want to use a technical stop loss, and this is a technical stop loss. Okay, that's why we use it at this high price here. All right, very good. So let's go on. And another example here is a bearish reversal pattern, which in this case we are going to use the shooting star and filter with oscillator, and of course confirm with price. So this is your inverted hammer at the top, and an inverted hammer at the top has a unique name called shooting star. Very good. And now we filter it with these guys here, the stochastics being above 80, so it means that they are at extreme overbought area, implying that a correction is about to happen, most probably. All right, and what do? You wait for the price to break below this low so you can sell, and at the same time never forget to place your protective stop loss at the top, at the high of this shooting star, just in case prices don't go in the direction that we expect. Okay, very good. Can you please explain again why we sell there? This is a shooting star. A shooting star, it's a bearish formation. Bearish means that after this candlestick, most probably the next candlestick will go lower, and many other candlesticks will follow in lower grounds. So we expect a decline. This is what it means. So to increase our chances, we don't just go short here. We look at our oscillator to see that indeed this oscillator is overbought. So now we feel more confident and we wait for prices to break below this shooting star. Now I feel more confident to go short. Okay, guys? Very good. So our stochastics is overbought. We have a bearish formation shooting star, and then price confirmation when the next candle breaks below the low price of the shooting star. Okay, guys, are you with me? Then we have another question here. Which oscillator are you using for the shooting star example? Okay, you can use anyone, but this is stochastics, guys. This is stochastics. This is percent K and this is percent D in stochastics terminology. We have a lot of webinars that we explain all the trend indicators, all the oscillators, how they are constructed, how they have been developed, all the parameters, and I'm sure that most of you that attended these webinars understand exactly what I'm talking about. We have more questions here. Please kindly explain where the support and resistance is on the chart. Do they matter when using these strategies? Mr. Oluwasen, Samuel Olajit. Yes, there are support and resistance, and one resistance is here, but at the same time, this level here is a support, here is a support, but on the way up, this is a resistance. So I'm sure that most of you know my views about support and resistance. I'm not really crazy about support and resistance, and I have a specific webinar about support and resistance where I prove that this theory doesn't really exist, right? So, but just to answer your question, if you find, identify, spot a formation, a reversal formation at a support or resistance, then it's a good thing for you. So your filtering is done through support and resistance, and then you wait for the confirmation. Now, we have another question here by Mr. Victor. Mr. Victor, what does the stop loss mean? Right? Mr. Victor Ekaro in Akwana in Nigeria. All right? So, stop loss means that I buy, excuse me guys, in this case I sell expecting prices to go lower. But at some times prices will not go lower, but instead they will go higher in the opposite direction. So when that happens and I have a stop loss here, I will lose some money that I know in advance that if that happens, I'm going to lose that amount of money. It's called risk management after all. So I manage my risk, because if there is no stop loss here while you are short and prices are going higher and higher, you will lose all your account. You will lose all your money, and you don't want that to happen. That's why you place a stop loss, just to protect the rest of your money. So you decide where to place your stop loss and how much money you are going to lose. All right. Basically, I use both stochastic and CCI oscillators together as a confirmation of the Haramis. Is it okay? It's not really confirmation, it's a filtering. Okay, but it's a very thin line between confirmation and filtering for the scope of this webinar. But if we have to be very strict, this is the differentiation. Confirmation is done with price. Filtering is done with other tools. So yes, you can go ahead and use any oscillator you like. You can combine them if you like, but just an advice, the more oscillators you combine, the more false signals you will get, okay? And you will get confused. So if you want to use one or two, it's fine. Okay, very good. Excellent, guys. All right, so we can move on since we answered all questions. And then here we have another one. It's trend line and oscillators. So we use two methods to filter. So here you are, you have an uptrend. By connecting the bottoms, this one is a little bit higher, and this one here, perhaps let me see here, yes. So this one will do now. So you see you have three bottoms touching the uptrend line. Actually, you know very well that you need 2 points to have a straight line, and if you have just two bottoms and a line running through them, then you have a straight line, an uptrend line called tentative uptrend line. And if you have three or more points, three or more bottoms in this case, then your trend line is called valid uptrend line. But this is for another seminar or webinar. Nevertheless, it doesn't really make a difference. If you have an uptrend line in place, then you have your hammer here at a support area. Somebody asked me before. So here you are, you have your reversal pattern touching your uptrend line. So what does it mean? It means that most probably it will bounce up and will go higher. Then you consult your oscillator, which happens to be oversold. So you have another filtering saying that, yes, it's a good area for this hammer to go up, right? How do you feel? You feel very good, right? So you have this guy here, hammer, saying, I'm going up. You have the trend line here saying, yes, it's a good place where you have identified your hammer. And then you have this oscillator, yes, 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 it's a very good idea. And you buy when the next candlestick breaks above the high of the hammer. And what do? You place your protective stop loss right here. Very good. Question, which oscillator do you use frequently? Okay, guys, it's a very interesting question. The oscillator that I use most frequently is called price. Okay? Here's another reversal pattern, which is called, how do you call it? Do you remember? Type your answer here, please. It's not a hammer, right? This is not a hammer. This is a hammer. How do you call this formation here that I don't really like? Do you remember when I introduced this reversal candle? I said I'm not really comfortable with this reversal at the bottom, but now you have a trend line, right? Inverted hammer, Mr. Nasser, very well. And this inverted hammer hits your trend line, so now you feel better, and I feel better myself already. And now you look at your stochastics, it's already oversold, implying that this correction downwards came a long way down, and most probably we're going up at some point in time. And if the next candlestick, right, breaks above this inverted hammer, then I feel, even myself, confident to place a buy order here. And of course, never forget that I want to protect my money, and I will place a protective stop loss at the low of this formation, of this inverted hammer. Excellent. Let's go on. Bullish reversal patterns, long wide body filtering with oscillators. It's not just one oscillator this time. We have more oscillators. Yes? So I use RSI and MACD for double filter the price action. Yes, Mr. Michael, it's a very good idea, and in theory, it's a very good combination. Please allow me to give you an exercise. Please explore how late, how lagging how much delay RSI and MACD show in their signals. In theory, they are the best oscillators. RSI is considered the most popular oscillator, meaning that most of the people use RSI. And the second most popular perhaps is MACD, and the third one, moving average. But I challenge you guys to see the delay in RSI and MACD. Sometimes it's good to have a delay. It will save you from false signals, but sometimes it will not allow you to enter fast enough in the market. So I think that the combination is not the best. Okay? All right. Okay, Mr. Michael, I hope I gave you my personal opinion on that. Please explore it a little bit, and we can discuss it again very soon. So here we have a long white body. Here is your long white body here, breaking above a moving average, which is very good. Then you have your stochastic that happen to be oversold going above 20, and your RSI, which is delayed, going from below 30, below at oversold extreme area above 30. So everything filters and confirms, this price confirms that we are going higher. Okay, so now we use three indicators: moving average, stochastics, and RSI. It's not a bad idea, but please don't use many lagging indicators together. So it's a moving average, it's a long white body that broke above the moving average, and then you have a failure swing. You know that is my favorite price pattern, a failure swing. And you have your oversold oscillators. All right? So now you feel confident to take the buy sell, pardon me, the buy order. Okay, guys, I apologize for that. You feel confident to buy. All right? Excellent. We go on. Shooting star and oscillators. Where's the shooting star? Here's your shooting star. Excellent example of a shooting star at the top. And then what? What do you have? You have oscillators saying that, yes, you are high enough, and most probably you are coming down. And then you have another shooting star here, and your oscillator says, yes, most probably you are coming down because you are overbought. Do you see that? And then the rest is history. You have this decline here and this decline here. And of course, remember that you sell here at the low and you place your stop loss at the top. You sell here at the low and you place your stop loss at the top. All right? We go on. Tower tops and resistance and oscillators. So we combine that. So I'm sure that you all agree that this is a resistance. Of course, you know my view about support and resistance and how to draw correctly the support and the resistance. I repeated myself many times, and I said that the resistance is always at the high price and not the closing price. And of course, the support is at the low price and not the closing price. Okay, that's why this is your resistance. But nevertheless, this is a long white body. You have short bodies in between, and then you have a long black body signaling the reversal. That's why this is called a tower top, touching a resistance. And now you feel more comfortable. And of course, you consult your RSI that says, yes, I am overbought. I reached extreme area. So now you are ready to go short. All right? Very good. Excellent. Now we have another example here, tower bottom and oscillators. So where is the tower bottom? Let's find out. Let me remove this one. So this is the downtrend. This is the definition of a tower bottom. long black body in the direction of the downtrend, small candlesticks in between, signaling a congestion, and then a long wide body. Yes, I know this long wide body is not that long as this one. All right. Sometimes you don't get the ideal picture, but in this case, it worked perfectly well. And what do you see here? You see your MACD being what? Oversold. So yes, the signals are in your favor. You have a support area, a reversal pattern called tower bottom, oscillators being oversold. So you feel more comfortable to take the buy order. All right? Excellent. We have more questions. Guys, slow down. I have to answer them first. So we know the market is not predictable, right? Who is this guy here? Mr. Samuel. Are there situations when the oscillator will not reflect the chart? Yes, many times the oscillator will not reflect the chart, and many times the oscillator will reflect the chart. I totally disagree that the markets are not predictable. The markets are predictable many times. Sometimes the market goes sideways, and this is the time that the market is not predictable. Mr. Samuel, if you are from Nigeria, I will be in Nigeria in July, and I hope I meet you there, and I will explain in every detail how to read the price chart and how to predict the movement of prices through failure, swing, and trend. Okay, but nevertheless, let me stick here. And here, what do you have? You have a dark cloud at the moving average, at a resistance, if you like, right? And then you have a resistance line. It's an internal resistance touching one point here, another point here, right? And this low here. That's why I called it internal resistance line. And now you even feel more comfortable now. And what do you have? A moving average as well. And you can sell at the low of this dark cloud formation. Never forget to place your protective stop loss at the high price of the dark cloud formation. And that is that. We can switch, of course, to our MT4 platform because we didn't do it. All right. So what do we have here? We have, let me get rid of these lines. Okay, guys. So I can switch to 5 minutes. This is Euro USD. Do you see something interesting here? Anything interesting? Well, is this a hammer? Is this a hammer? Here? Is this a hammer? Yes, it's a hammer. Is our stochastics below 30 and moving above? Yes. Signaling oversold extreme area. So stochastic says, yes, I agree with you. And the next candlestick breaks above the top of this hammer, right? And you are ready to buy here. The rest is history, and you place your stop loss here. That was not needed, but you place it just in case, because sometimes the market will not go in your direction. So is there anything else that is interesting here? What about this guy here? Is it too long? Perhaps this shadow is too long, but I know that some of you will experiment with that, and you see that this shooting star has been filtered by stochastics being overbought, and then what happened? And then you wait for the confirmation, of course, right? Where's your confirmation? This candlestick breaks below the low of this shooting star. So you short here, and of course now your risk is higher because you are forced to place your stop loss right there. So let me find something else. Do you see anything else that is interesting? Perhaps this engulfing pattern here, or perhaps this harami here. Do you see the harami here, guys? Do you see this harami? Yes? So, is it oversold? Very good. So, you identify these two candlesticks as harami. You have a downtrend, a decline. You find at the bottom a harami formation. You look at your oscillator, it's oversold. So when the next candlestick breaks above the top, the high of the long black body, then you go long and you place your protective stop loss at the low, right? And the rest, of course, is history, profits. So use daily chart. I will do that now. Here is your daily chart. And do you see anything interesting here? All right. What is that? Is it interesting? What do you think about this one, Mr. Eric? Do you see this one? What do you think about that? All right. So this guy says, I'm a shooting star at the top. Then you consult your stochastics. It's not really overbought. So you have second thoughts, and then your price breaks below. What do? It's up to you. If your oscillator does not filter, then perhaps you say, I don't want to take any risk. All right? Or you might say, yes, since the oscillator does not filter in my favor, then I will sell, but less amount. All right? Okay, it's up to you how to handle that. But let's find another formation. What do you have here? Just very fast, I'm going through. Just if I find something, what is that? Look at that, guys. Again, this is what we have been discussing today. Another shooting star. This time is overbought, so I feel very comfortable to go short. Where? I will go short here, right? At the bottom of this candlestick. Let me just move it a little bit higher so we are fair. So here I will sell, protective stop loss here, and I will take my profit. Well, that's another webinar where we are going to take our profit, right? But you can decide that. You can play with your risk to reward ratio, all right? And of course, let's look at another question. Explain how to set stop loss at the overbought of the cloud. Again, it's the highest price or the lowest price. Okay, Mr. Conrad, let's say that you have a formation of two lines. All right, you have a formation of two lines, bearish or bullish. Then where do you place your stop loss? If it's a bearish formation, meaning that you're going to sell, then your stop loss is at the highest price of the formation. And if you're buying, so it means that you have a bullish formation, then your stop loss is at the lowest price of the formation. Hello, Andreas. Can you apply this strategy to options? Well, options depends if you are implying binary options, whether you have a time limit in it, and I'm not familiar with that. Okay, I don't like this time restriction, to be honest. Okay, we don't have that in our strategies, but you can try it and see the entry point. You can filter and confirm your entry point, so you have more chances on your side. Okay, guys? Is there anything else that you want me to show you here? Let's see if GBP USD crashed or not. Let me just put it here on the daily time frame. GBP GBP/USD. We're going down, guys. Do you see it here? It's very close, very close. Mr. I'm looking to see you on the next webinar. Thank you. I have lost. Would you like to hide all webcams? Stop sharing your camera? No. Okay. Thank you, Emmanuel. It was my pleasure, of course, and I hope I see you soon. And I hope I see you on location in your own countries, guys. And if we don't have any other questions, I would like to thank you for attending today's webinar. I hope you enjoyed it. I'm sure you enjoyed it. I'm sure you learned something new, because I see that from your feedback, from your participation, from your questions, and I'm glad for that. And I hope I see you soon in the next webinar that will be sometime in the end of July, and we will announce the title of the next webinar very soon, and I'm sure you will find it very interesting. All right, good trading, and I hope I'll see you soon. Bye from me.
Thank you everyone for attending. We hope to see you soon. Have a good afternoon.